The Bank of Canada just dropped rates again, and while everybody's celebrating, I want you to pause, because being financially literate isn't just about reacting, it's about understanding. Today, we're going to take a deep dive into what this actually means for fixed and variable rates, so you can come out of this with empowerment, being able to make a decision off of that, and not just being another statistic. So we're going to be looking at a couple of different things. Firstly, what the rate environment here in Canada has looked like over the last 5 years, and what variables have been in play to make these changes. Next, we're going to look at what the rates have looked like since the beginning of 2025, and what variables have been at play there. Next, we're going to look at the overall strength of the economy here in Canada, and then we can go off of that to make a prediction on what rates are going to be doing here going forward. Let's walk through the last 5 years, because boy, has it been a doozy. And looking at the last 5 years, we have to start at a time we know oh too well, the pandemic era. So in early 2020, when the pandemic hit, economic activity tanked, private spending disappeared, and businesses across the board started to shut down. The velocity of money stopped, risk expectations went through the roof, and there was no expectations at all when it came to inflation. In response, the Bank of Canada slashed its overnight rate, seeking to support the financial system, overall credit flow, and the employment here in Canada. Variable rates plummeted, and fixed rates fell close behind due to the low bond yields. This created a huge stimulation in the real estate market and an overall surplus in liquidity here in Canada. It was a really good time to borrow money. So this brings us to 2021-2022, when we begin to see a rebound in the economy, but at the same time, we start to see inflation run out of control. The economy reopened and demand surged. Spending, investments, the housing boom, it was pretty out of control, not to mention all of the shipping constraints and overall supply chain constraints. Remember that ship that got stuck in the Panama Canal? That was a huge factor. So at this point, inflation begins to run out of control. It was at this point that the Bank of Canada did a complete 180. Instead of supporting the economy at all costs, it was stop inflation at all costs. And at that point, we started to see the policy rate rise. And shortly after the policy rate started to climb upwards, the bond yields did the same. And that's why we saw variable rates skyrocket and fixed rates come close behind. It was no longer a good time to borrow money. So now this brings us to late 2022, mid 2023, where we reach the point of what I would call the peak of monetary policy, where the Bank of Canada has gone from a super low, historically low 0.25% in March of 2020 to a staggering 5% overnight rate in July of 2023. And like I said, at the same time, variable rates were increasing because of the overnight rate, fixed rates were increasing as well. So those that locked into a low fixed rate were unaffected, but those looking to requalify for a new mortgage, purchase, refi, renew their mortgage, were faced with fixed rates that were following the increasing bond yield. Into the second half of 2023, we start to finally see inflation get into line. At that point, we're no longer expecting rapid rate hikes, but more rate pauses. And later, third, fourth quarter of 2023, we start to finally see the bond yield drop, at which point fixed rates come down a little bit. But it wasn't for about 6 or 7 rate announcements that the overnight rate, which affects variable, started to finally see reprieve. The key takeaway over the last 5 years is when inflation, labor markets, and overall growth are strong, rates tend to go up. And when inflation weakens, the job market weakens, or there's an overall disruption in the economy, possibly globally, that's when we see rates drop. But you have to keep in mind, fixed rates move based on bond yields, and variable rates move based on the overnight rate, which affects prime rate, subsequently affecting your variable rate. They do not move in sync. When you ask yourself, where are fixed rates going to go? It's not as simple as just going off of what you expect the Bank of Canada to announce. You're more or less going off of the overall economic backdrop, inflation, labor markets, bond yields, and making an educated decision based on all these different factors. Now, I'm going to give you a deeper understanding on the things like inflation, economic growth, bond yields, labor markets, and overall global structure. Here's a good way to understand inflation. When the price of goods and services rise persistently, the people need to earn a higher income just to maintain the exact same lifestyle. This erodes purchasing power, and the central banks view it as a threat to long-term price stability. When inflation ticks up, the Bank of Canada increases their policy rate. This slows demand, also slows the increase of wages, and overall anchors their expectations for inflation. On the fixed rate side, higher inflation results in bond investors needing higher yields to become profitable, which in turn affects fixed rates and has them increasing. To understand economic growth, you need to understand the acronym GDP. GDP stands for gross domestic product. And to summarize very briefly, when GDP growth is up, rates go up. When GDP growth goes down, rates go down. And interestingly enough, immigration actually plays a big part in this. When there's high immigration, Canada's labor market expands. Consumerism goes up, there's more people buying homes, renting homes, overall consuming in the economy. This conversely can lead to an increase in inflation, which may push rates up over time. Speaking about the labor market, a tight labor market may actually lead to increasing rates as well. A tight labor market means low unemployment, high participation, and wage growth. This signals an increase in the cost structure of that business business may pass on to the consumer via their prices. This would then push inflation a little bit further. And for borrowers, a strong job market justifies higher rates because everybody's working, people are making more money, and with more money, they have more affordability, thus justifying higher rates. Back to immigration. An increase in immigration actually has the ability to cool inflation. It does this by expanding the labor force and reducing the pressure on wage increases. I'm not going to bore you with all the intricacies of the 5-year Canadian bond yield, but it's just important to know what it influences and who is dependent on it. Lenders, on one end, are one big investor in the 5-year Canadian bond yield. So that's what they use to predict the future in terms of their pricing in their fixed rate mortgages. And that's why fixed rates are really dependent on where the bond yield's going. It's also really interesting to look at what affects the 5-year bond yield. If we're going back to 2021, when rates went through the roof, we can look at the Panama Canal being blocked up. That increased supply chain pressure and inflation globally. This is why we saw a big increase in our bond yields here in Canada, which was directly impacted by this global event. It's not just domestic data, it's global data too, which are all little variables in the overall movement in our bond yield. So lastly, let's touch on global structure, because you might be surprised at how much the global landscape affects fixed rates here in Canada and the bond yield and possible Bank of Canada decisions. The example I just made with the Panama Canal, that was a global event that drastically affected our bond yield. Another one is our uptake in immigration. Our huge influx of immigration between 2020 and 2025 has been a direct influence on where our inflation has gone. We've got a huge demand on housing, overall supplies, and we may not have enough jobs here in Canada to properly support all of the immigration that's taking place. Another interesting aspect, which would be applicable a lot more recently, would be tariffs. Because like I said, lenders invest in bonds and they have to make a spread at which their investors will make money. The overall economic uncertainty that has come from these tariffs has actually made that spread a little bit bigger. So even though bond yields have been dropping for a few months now, fixed rates haven't followed directly, and that's just directly caused by economic uncertainty. Now that we've gone through all of that, let's look at what rates have been doing this year in 2025. Since the beginning of the year, we've seen a few rate drops by the Bank of Canada, the most recent one being on October 29th, bringing the policy rate down to 2.25%. This is huge. From mid-2023, where it was at 5%, down to 2.25. This is amazing for anybody that's been on a variable. You might be asking yourself, why was the Bank of Canada so reactive to bringing the policy rate down so quickly? You know, in a 2-year span, we've gone from 5% to 2.25%. And that's based on a few of the variables we just spoke about. GDP growth is down this year, unemployment rate is up, and inflation has decreased, of course, since 2023. So inflation has dropped quite a bit since 2023, but it is still a bit elevated. With the target being 2% every year, we're sitting at about 2.4, with core inflation being at just about 3%. The bond yield has followed in respect to dropping recently, but like I said, there are other factors than just the bond yield coming into play when we're talking about the movement of fixed rates. So in short, is that weaker growth plus slightly elevated inflation leaves room for not only policy cuts, but the reduction in fixed rates. So if you're on a variable rate, this is great news. We're seeing prime rate come down with the overnight rate, which just at the end of the day makes things more affordable to you. Depending on which variable you're on, static variable versus adjustable, you're going to see the rewards either in a quicker payoff of your mortgage or just a lower monthly payment. And on the fixed rate side, well, fixed rate means your rate's not going to change. It's not going to change for the life of your term. But if you locked in at a fixed rate, call it mid-2022, 2023, and you're at a really high rate, there's a ton of opportunity for you to break that rate and get into a much more affordable mortgage right now. If we're going to be making an educated guess on where we think fixed rates are going to be in the future, we need to know where the present world economic state is and the Canadian indicators are right now. Globally, the economy is slowing down. This tends to ease bond yields and gives central banks room to either pause or cut their rates. Currently, the Canadian bond yield is at about 2.7% from a high of about 4%, and the Bank of Canada's policy rate is down to 2.25 from a high of 5%, a couple years ago. Unless the bond yield drops significantly, or at least gradually over a long period of time, we don't really have a lot of expectation for fixed rates to keep coming down. And variable rate, on the other hand, is directly tied to the Bank of Canada's rate announcements. We're at 2.25% right now. If it keeps going down, we will see prime rate keep coming down, subsequently affecting variable rates. And don't forget, lenders, investors in bonds use a spread based on overall economic certainty or risk to calculate their 5-year fixed rates. So even though bond yields might continue to drop, depending on what's going on globally, we may not see fixed rates come down because their spread just becomes wider and wider. So what does this mean exactly? Well, if you're locking into a fixed rate, just know that you're locking into a rate that is already taking into account the factors that are affecting the market. And on the variable side, it's just important to keep in mind that the Bank of Canada is the determining factor when it comes to the increase or decrease of variable rate. Prime rate, which is influenced by the overnight rate. And an interesting variable to keep your eye on as well is lenders' rate discounts, because when you're getting a variable, it's going to be prime minus something. When lenders decrease their discounts, basically increase their variable rate calculation, that's a good indicator that the lenders expect prime rate to drop. When lenders start to increase their discount, essentially decrease their variable rate, well, that's them expecting for prime rate to stay stable or possibly increase in the foreseeable future. We've looked at past, we've looked at present. Now let's look at future projections for fixed and variable rates. With the bond yield at 2.7%, we might see fixed rates come down a little bit more, depending on overall economic certainty. That's going to be dependent on the man south of the border. He's going to need to make the entire world feel a little bit more certain about the economics before things change. And if inflation keeps coming down closer to that target of 2% and GDP growth stays relatively weak, well, that's going to be a huge indicator that we're definitely going to see fixed rates come down. But on the flip side, if inflation creeps up, if the job market tightens, global uncertainty arises, we may see that do a 180. Now, on the variable rate side, the Bank of Canada did just drop their overnight rate by 0.25%. While doing this, they also signaled that this will likely be the last cut for a while, meaning that they're probably going to hold it for quite some time. If the economic conditions deteriorate a little bit more, we're likely going to see the overnight rate drop as well. The key data points to keep an eye on are going to be inflation, that's CPI and core inflation. CPI stands for Consumer Price Index. You're going to want to keep an eye on the GDP growth or possible contraction, and same thing with the labor market, the growth or possible contraction. You're going to want to keep your eye on the bond yields, both the 5-year and the 10-year bond yield, and the overall Bank of Canada commentary, what they're saying. They send out reports all the time. They have 8 announcements per year. These are opportunities for you to get a good idea on future expectations and the current economic state. If you're watching this and wondering whether to go fixed or variable, here's my honest take. If predictability and stability are something that help you sleep at night, well, I'd go fixed, but you're paying a premium for that peace of mind. Now, if you're comfortable riding that short-term flexibility with a little more volatility and the expectation that the economy is going to soften further, well, variable might help you save a lot more money over time. Either way, the key isn't just the rate you get, it's the plan behind it. You want to make sure that your overall mortgage synergizes with your current situation along with your future goals, that you're not just hyper-focusing on rate, but overall flexibility, portability, prepayment privileges, penalties, the whole 9 yards. And then with all of this, have a conversation with your broker to help understand your risk tolerance and see if fixed versus variable. Go through scenarios. What if rates rise? What if rates fall? Don't be a statistic, be strategic. So here's the conclusion. Bank of Canada rate cuts matter, but they don't automatically drag down fixed rates. Fixed rates move with bond yields and overall investor sentiment. This moves with immigration, inflation, and overall global economic health. Canada's current economy is fragile, not collapsing, but far from booming. The next 6 months are crucial. If the economy weakens further, we could see rates drift lower. If for some reason inflation resurfaces, well, we could see a big pause or possibly even a reverse. My job, my passion, is to help you navigate all of this with clarity. Whether you're buying, renewing, or investing, my goal is simple: help you make educated, informed decisions that fit your life, not the headlines. So don't be a statistic, be informed, be prepared, and let's get connected.